Hi everyone, welcome to Clear Money Tea, and today we're going to be talking about dividends, specifically a dividend yield trap. So before getting into this dividend yield trap, let's talk about cash dividends. So a cash dividend is money paid from a company for each unit of shares you own. And a dividend yield is if you take the dividend that they're paying, either the trailing 12 months or the most recent dividend annualized, and you divide it by the price, you get the dividend yield. And let's put this dividend yield into some more context. So if you compare it to the interest rate on a savings account, for example. So let's say that you open up a savings account, pays 5%. At the end of the year, you now have $105. Now let's say you invest in a dividend-paying stock. You purchase a dividend-paying stock for $100. The dividend yield is 5%. That means it's going to pay a $5 dividend. Yeah, that dividend yield, 5 divided by 100, you get 5%. So that's one way to think of it. The difference is that that's only part of the picture when investing in dividend-paying stocks. So dividend-paying stocks, you have that dividend that we talked about, which is what people are looking for, and you also have price appreciation. So for that example, you buy it for 100, pays out a $5 dividend, but let's say at the end of the 12 months that now the price is 200. So now you've got the $5 dividend and you have an additional 100 from the price appreciation. And these are, very all simplistic examples. It's barring taxes, reinvestments, transaction costs, all of that stuff. So just a rough example so you can get the lay of the land. Okay, so now that we have some of the basics down, let's now get into the high dividend yield trap, which is selecting for the stock that has the highest dividend yield. So if you're interested in dividend paying companies, you might be tempted just to look for the company that has the highest dividend yield to get the highest return on your investment. But there's some problems with that, and that is the dividend yield trap. So the dividend yield, like we talked about, is the dividend divided by the price. You can either get a high dividend yield of only one of two ways. So it's either going to be the dividend is increasing, which is good, or it could just be that the price has decreased. Maybe it's still an attractive investment, but others aren't seeing it that way. It could be things with the broader economy or happening in the sector or the individual company. And that's where you really need to be careful, was when the dividend yield is high due to decreases in the share price. And the reason why you need to be careful is because dividends are not set in stone forever. Companies can cut and do cut their dividend. The whole reason why you purchase shares in this company might have been the dividend yield, but then the company turns around and cuts the dividend, and then now the whole reason why you purchase this company is now gone in the wind. And like we talked about too, that there is two components to your return when buying a dividend paying company. It's the dividend yield and share price appreciation. But both of those, can decrease too. Your share price can decrease actually, so you have share depreciation, or your dividend yield can decrease, so where they cut the dividend. When you're looking at these companies, there's other things that you need to take into account too. Companies often target, a dividend payout ratio. So maybe they want to pay 30% of their earnings as dividends. And that's where you get the dividend payout ratio. It's the dividend divided by earnings. Now let's get into the example I was saying where the share price can decrease. If a share price is decreasing, you have to think into why. So share price decreases, you now have a higher dividend yield, which might seem attractive, but why did the share price decrease? The share price might have decreased because the earnings potential is not as high or as attractive, or if that is the case, so if we're expecting lower earnings, then that is going to mean that a company is going to be paying a higher percentage of their earnings as dividend. And now let's take an extreme example of that. A company has a 30% dividend payout ratio. They pay 30 cents as dividends. They make $1 in earnings. So now things aren't going too hot for this company. Their earnings have now dropped to $0. So from 1 to 0, they're not making any money, and they're not expecting to. They're actually probably gonna lose money in the future. So now what do you think is gonna happen to the dividend? Are they gonna continue paying a dividend while they're not making money? So they might do it for a quarter or two, but they feasibly cannot pay money if they aren't making any money. That is like the thing that you need to be careful of when the dividend yield is high, and it's high because of the share price has recently dropped. So yeah, and it's not always going to be that way. Some companies may always seem to have a high dividend yield, and some of it can be a function of the type of company it is. REITs tend to pay a high amount of their earnings as dividends. Oil and gas companies tend to have high dividend yields. So some of it can be very sector specific, but in general, if you're looking at a specific sector, you're looking at a specific company, and you're seeing something happening with the dividend yield, you're going to want to pay more attention to it and not just buy it because the dividend yield is high. Now we're going to look at an example of a real company, PacWest, and we're going to see what's happened with their dividend. So if we look at PacWest Regional Bank, look at their dividend history. So they've been paying out a dividend for a long time now. Their dividend was increasing and had been increasing for years, and it was cut in 2020. I will give you one guess as to why the dividend was cut in early 2020. And then it was pretty stable at 25 cents a quarter, so $1 a year. And then it was cut May 2023 to 1 cent. So let's rewind in the past. We're going to say it's now March 2023. End of March, beginning of April, SVB has collapsed. There's been a big impact on regional banks. And we can see PacWest ends up trading at around, we're going to say $10 a share. Now we're taking a look at their dividend at that time. It was 25 cents a quarter, like I said. So 1 divided by 10, that's a 10% dividend yield. So that's pretty high. So if you're a dividend yield chaser, that might seem, like a good deal. You're solely concerned about the dividend. You don't really care what happens with the share price. You're like, if the share price drops to $2, it doesn't matter as long as you get that dividend. So, but the issue there is that the dividend, like I said, can be cut. So we can see what happened in May. So they cut their dividend to 1 cent. So if you purchased PacWest end of March, beginning of April, solely for their dividend yield, you now have essentially no dividend. Your dividend has now decreased from 10% all the way to under 1%. And if you want to get out of the company now, you're now looking at over 30% depreciation in the stock price. So that is the danger of only looking at the dividend yield and not taking into account the financial performance and outlook of a company, because all of that is going to impact whether or not you're going to have any sort of dividend. And like I said, this is just one example. Of course, there was other regional banks who didn't cut their dividend. All regional banks had different exposures as well. So you're going to want to take into account the specifics in terms of like the impact on expected earnings and their ability to be able to support a dividend in the future. Okay, so let's say you're interested in dividend investing. You're not going to just be dividend yield chasing for, 15% dividend yields. You want to try and find some companies to invest in. You don't always have to do a specific company. You can do ETFs that target dividend yields. So, and there's a couple of them out there. There's some Vanguard ETFs. There's Schwab. There's some international ones. Vanguard and Franklin have international ETFs. Spider also has like an ETF too. There are definitely a few ETFs out there if you're interested in receiving a dividend return. And so, yeah, like I said, though, the dividend yield isn't the end-all be-all. You're going to want to take into account your total return, because some of these ETFs or companies might not pay a very high dividend, but when you take into account your total return, which is your dividend and your price appreciation, when you take all that into account, you may be better off total return-wise with the lower dividend-paying ETFs or companies. So that's something you want to take into account when you're looking and you're investing for dividends. And overall, though, if you don't want to, you don't need to target dividend yields or dividend paying companies, but everything really depends on lots of aspects. what is your investment horizon, what's your liquidity needs, what's your risk tolerance. So all that's gonna impact on whether you want to focus on dividend paying stocks, whether you want to have more in cash in a savings account. All of your portfolio balance is going to depend on all of those different aspects. What are you guys doing? Are you looking for high dividend yield companies? Which ones are you investing in? Which ones are you liking? And has this changed your outlook and whether or not you want to go for that highest dividend yield company? But yeah, let me know. But thanks for stopping by.